Brutal truths about trading I know 5 years in, I wish I knew from day one. I'm Manir, also known as Ghost Trades on Twitter, and I also run Unbiased Trading, an agency where we can backtest or automate your trading strategies. Now, number one is success comes from simplicity and avoiding mistakes rather than complexity.
In the markets. It's success in markets is more about not doing a lot of dumb things, avoiding the dumb stuff. I truly think that. Every year I try to do less of the things that don't work. I think if you've been consistent and following rules and also grown your account, that's when I think you can add money to your account slowly. But if you have problems not taking losses, even though you get stopped out, if you have these basic things you're not able to do, you shouldn't add money to your trading account. But
I think Kulamagi is completely correct here. He is obviously one of the most profound and successful traders that is kind of well known on Twitter and well known in the space. If you haven't heard his story, I definitely recommend searching up Kulamagi. He's got some amazing interviews and he shares a lot of value. And he even used to do a lot of streams of his trading as well. Now, I think this rule kind of applies in multiple ways. I think you can apply it in the way that Kulamagi is saying, where if you can't follow basic rules, then you definitely shouldn't be adding size to your account. You should be trading with a very small account until you can kind of hit that consistency with those basic rules. And I think it also applies in terms of strategy development. So when you are designing strategies, obviously you want to come from a place of simplicity. And a lot of the times, some of the better strategies I've developed have simply been working on removing the key mistakes of that sort of strategy type. So for example, with a trend following strategy, you're wanting to try and just maximize the winners and then all the other losses should be as small as possible. Ideally, that's kind of like in the perfect world. So obviously you're going to have a low win rate, but your winners are going to be 5R, 10R, etc. Especially in markets that are very volatile like crypto, you can do really well with trend following or even like momentum, etc. Now, number two is that there's no holy grail strategy. You're aiming to create a group of uncorrelated strategies. No one strategy will be perfect for all market regimes and types.
Let's dive in a little bit, if you don't mind, into how you consider building a basket of non-correlated systems. How many systems should you have? What types of systems would you be considered to be the core types of systems for a good balanced portfolio?
So how many systems? Again, it depends on the comfort zone of every individual. Every individual is different. I trade more than 50 systems simultaneously, and I'm very, very comfortable with that. The reason I trade so many simultaneously is to lower corporate risk, basically, which is a big thing on stocks, of course, especially if you short them. But it depends. I mean, you have people that are totally happy with 10 or 12 non-correlated systems, but you basically can split them up in long-term trend following. Then you have long mean reversion, short mean reversion, and short trend following. Those are the four basic styles.
Now, this is one that is a really common misconception when newer people are getting into trading. They're often getting advertised, golden strategies that have 100% win rates, 99% win rates, etc. And for the reality, that's just never the truth. The best approach we have ever seen is that you combine uncorrelated strategies together, and then over time, that normally is the best risk-adjusted return, meaning that you have kind of smoother drawdowns, and then you can still gain those sort of returns using uncorrelated strategies compared to just putting all your capital in one particular strategy that's focused on one particular type. Now, if you want to research this even more, Ray Dalio has an amazing presentation around the holy grail in finance and around diversification during assets. Then obviously this approach is then applicable to strategies, and you can also look around it on Jim Simons as well. I also have a Twitter post around uncorrelation, so if you search up Ghost Trades, you can find one of those as well. 3, if your trading feels exciting, you're probably doing it wrong.
And so if you're not going to be more profitable than a system, then yeah, you should be trading with a system. If your objective is to make money, if your objective is to have fun, then yeah, don't trade systematically. Just put a small amount of money in your account and have fun. That's fine. I'm not going to tell other people what they should do for entertainment. Personally, I don't find trading fun, and I don't do it for my amusement. I do it to make money.
I completely agree with Robert Caravir here that if you're looking to make money, realistically you should be following a system. Now obviously some traders are extremely gifted with their discretionary approaches and market reading, or they have just tons of experience, they've been trading maybe for 10 plus years. But if you're newer, it's normally more beneficial to actually follow systematic rules. For the reason being is you don't have 10 years to back up your decision making. Those people that have been trading for 10 years have seen a lot of the markets and also have been able to trial and error a lot, meaning they have a good sample size to make solid decisions over that 10 years. But even then, a lot of successful traders are also systematic, meaning that they use data in some way to inform their decisions. And I think now trading for 5 years, that anytime I feel super excited is normally when I'm doing something wrong for the most part, or I just had too big size on a particular trade or a particular strategy. So this is definitely a thing that stays true. I will say in your first year of trading, it's going to be very difficult not to be excited by trading. It's, a new dopamine for a lot of people, and, making money in 5 minutes or an hour or whatever is a completely different and amazing feeling in some ways. So I think it does take time to kind of normalize out, but you should be trying to get your trading to be more boring rather than exciting. For me personally, the more exciting part now that I try and channel is that building strategies, finding strategies that actually work, etc. That's a really exciting part for me, or even just doing research in general. But the actual deployment of the strategies, I try and remain very calm overall, because sometimes I'll be in a drawdown for a month or two on a particular strategy. So you just have to be fine with that sort of volatility when you are deploying and testing out strategies. Now, if you're looking to make your trading more boring and more systematic, I've opened up the Backtest Bootcamp. It's going to save you hundreds of hours with proven code templates, and you're going to learn how to build robust, profitable strategies from zero. You'll also then be able to build unshakable confidence through data. Now, if you're interested, I've left a link at the top of the description where you can click and you'll get a free essential starter kit for backtesting. And then from there, you can make the decision if the Backtest Bootcamp is something that would be beneficial to you. 4, you will be in drawdown most of the time.
You never stay at peak equity for long. This is actually one thing I got from Peter Brandt on his blog. He explained it really nicely. I never thought about it before, but even the most successful traders and investors are gonna be in a drawdown most of the time. Even this year, even though I'm up at least 500%, I haven't checked it exactly, but it could be 600-700, maybe not 700, it could be 600%. I've spent at least half of the year in a drawdown, at least. So expecting to be like peak equity all the time, it's just not gonna happen. You're gonna spend most of your time in a drawdown, even on a really good year. That's just how it works. You just need to realize it, and you need to accept it.
This is a revelation that I don't think many traders really have, maybe until like later into the trading journey, is that being at all-time highs is a very short-lived experience. You will break all-time highs maybe for a week or maybe even a day, depending on how many trades you're taking, and then you'll be back into drawdown. So don't have this kind of idea that you're going to always be at all-time highs, you're going to be breaking all-time highs every single day. For the most part, most people will be going into drawdowns maybe for a week, maybe a couple days, maybe even a month, maybe a year. And that's just a natural part of trading, depending on your strategy types and also your kind of time frame. So if you're doing swing trading, it's more likely that you're going to be in drawdown for maybe a month, maybe even a year. And that's something that's just going to be able to happen. So it's a brutal truth. There's no way really around it. You're just going to be in drawdown most of the time. 5, most newer traders mistake luck for skill.
Whether your kind of qualitative calls that you're then making are actually profitable or not. Because it's very easy when trading to confuse luck over skill. So you do 4 trades and they all make money and you think you're Warren Buffett, right? In practice, you need a lot more trades than that for statistical significance, and that's not appreciated.
I think there's 2 really important things here. The last thing Robert Carrier said is you need a lot of samples for statistical significance, and that is very true. I see many newer traders think they can get away with 50 trades on a backtest or manually charting 50 trades. Realistically, that means nothing because you have human bias, and also it's only 50 trades. You should be aiming for multiple hundreds, maybe even thousands of samples to actually be able to get some good statistical significant data. And then number 2 of it is it's very easy in trading to get overconfident or underconfident. That was definitely something in the earlier years that I was really struck by, and even still nowadays, I'd say it's one of my biggest kind of cons is I'm able to get really overconfident quite quickly, and then I can lose a lot of confidence quite quickly as well if things take a turn. So it's something you have to balance out over time, and for me, the most effective method has just been believing and trusting my data. So that's why I take backtesting so seriously, because if I can have statistically significant results, the results look good over many years, etc., then I can just have trust in that, and it's kind of taking away trust from the actual strategy deployed live and more placing it on my actual proven data. And then from there, I can make decisions. If the strategy actually ultimately does not work, it will then give me indications of that. When you're just discretionary like I was in the first 6 months, it's very easy to have 5 good trades and think this new approach is the one that's going to make you rich. For the most part, it could just be luck that you got 5 trades, winning in a row, and then maybe your next 10 trades are all losses. So you gotta have to be able to handle that sort of part, and then you're gonna have to find a way of where you're actually gonna find confidence and conviction from, whether it's gonna be data or whether you're gonna be trading, over 5 years and you're gonna slowly build that up over time, or if you have a different approach as well. Now, if you find this content valuable and want more every single week, feel free to follow me on Twitter at GhostHawkTrades, or feel free to subscribe. I'll post a video about once every week. And apart from that, have a great day.